Hey everyone, welcome to Doc W Trades. It is April 29th, 2026, a little past 3 o'clock in the afternoon. Today is a Fed day. Um, as you can see here, taking a look at the S&P 500, we are just bouncing around below the uh, where we began the trading session. As you can see here, this blue line is where we started the trading session for today on Wednesday. And out of the corner of my eye, I look and I'm seeing Jay Powell, Jerome Powell. He has been the Fed chair for the past about 8 years. So 8 years of my life I have been living for the past 8 years, seeing Jerome Powell control monetary policy. He is occupied, consumed 8 years of my life. I know everybody, in their day-to-day life, when it comes to politics and so forth, I always get a sense that the main person, the number one person that they pay attention to, that they follow, monitor what's going on and so forth, is the president. And so they get very emotional about who the president is, what the president says, what the president does, all that different stuff. The president has a big impact on the average person and how they go about their lives. And so there's much more of for the average person, there's much more, a bigger impact on their day-to-day lives for who the president of the United States is. But, and I get it, the president's a big deal. As we're watching here, the S&P 500 starting to move up a little bit. I'm going to switch over to the NASDAQ intraday chart. Take a look at the NASDAQ at all. As I'm telling my story, I'll go back and forth between the NASDAQ futures and the S&P futures. And I get it. The president is a big deal, especially the current one. We're living in a very divided world. And in the history, in the future, when they look back and they say, what was life like in the 20s? The main thing that people are going to say is, oh, it was a very divided time. It was the era of populism and kind of like a digital civil war, maybe. And so, depending on what side of the aisle on, what are your thoughts, what your beliefs are, all, you either love the current president or hate the current president. And I personally don't really want to go down that path if I don't have to. I even now have people that love the president, 3 or 6 months ago, and now they hate him. And others, they hated the president 6 months ago, and now they love him. So it's really crazy. And with everything going on in the world today and how every technology and information moves so fast, that's a very divisive thing. However, the one idea that I've always thought about and noodled on, and I don't know, I have never heard anybody else talk about this, but it is something that I noodle on, is that for people, and maybe people aren't even consciously aware of it, but for people in Wall Street, and whether they're professionals on Wall Street or non-professionals on Wall Street, it's just retail investors that pay attention to the markets. People that watch Bloomberg, CNBC, that go on YouTube and watch Tasty Live, or various content creators like Don Kaufman or Emmett is investing or Chris Camille or are now following Tom Sosnoff on Lost Dog, whatever. All the different types of retail investors that follow the markets and so forth. We pay attention to what's happening in Washington and follow what the president is doing and what the president says because it affects the markets. I mean, as I'm speaking right now, taking a look at the NASDAQ, when we look at the S&P 500, but we can also take a look at crude oil. Okay? This is a huge move, okay? And this is based on the latest news of the day that the Trump administration is looking to end the peace treaty, end the ceasefire, and is looking to drop bombs. And the Strait of Hormuz is going to have problems and is going to be closed. And that means that oil's going up. And in the past, that has been bearish for stocks. I've talked about how before the stock market had its V bottom 2 weeks ago, or a little over 2 weeks ago now, there was a direct inverse correlation between what stocks were doing and what crude oil was doing, except for the energy stocks. Well, today, if you take a look at the watch list, you'll see that the NASDAQ is up, QQQ is up, the SPY is down a little bit, but not that much, and semiconductor stocks are up, energy stocks are up, financial stocks are up a little bit, and crude oil is up $7. So the pattern that was very evident about 3 weeks ago, 4 weeks ago, is no longer the case. So noticing those patterns and noticing that tape action is very critical. So what I was going on to say is that, like, yes, the president can have an impact on what markets do, for sure, no question about it. But as Powell speaks and yaps and yaps and yaps like a 12-year-old girl, Jerome just yaps and yaps and yaps. I think personally that if you are involved on Wall Street, whether you're a professional or just a retail investor that follows the markets, the Federal Reserve Chairman has a much, much more greater impact on your day-to-day life. Not just on how markets move, but your day-to-day life. What you pay your mortgage, what you pay at the grocery store. And we saw this very clearly over the past 5 or 6 years with Jerome Powell. Okay? I mean, this is his last press conference, and before he goes, you can sit back and think about how he had such a big impact on your day-to-day life. Over the course of 5 or 6 years, prices basically doubled. And you can say that a big part of that is because of him as the Federal Reserve Chairman of the central bank of the world. I remember, yes, there was supply constraints. Yes, people got checks in the mail. But the central bank clearly said, through both administrations, Trump and Biden, this is transitory. And I said, no, this is going to be bad. This is going to be bad. And I think, generally speaking, you can make the argument, and a lot of people may disagree with it, is that the Federal Reserve Chairman is the most influential person in the world for the average day-to-day person. It's just they don't understand it. They don't realize it. They don't recognize it. Because of the way the Federal Reserve has influence on all markets, on all prices, and how inflation and their second mandate, full employment, has an impact on everybody's life. And I think Jerome Powell was probably the worst Fed chair since Arthur Burns. And Arthur Burns was the Fed chair in the late 60s and 70s that basically allowed, or is blamed at least, for allowing inflation to get out of control in the 70s. Now, lots of people have various arguments for, it wasn't just Arthur Burns. It was lots of dynamics that were going on underneath the surface. We went off the gold standard. You had the Vietnam War. You had baby boomers that were coming of age, and they were all looking to buy homes, and there wasn't enough supply, and that caused a lot of the inflation, so on and so forth. But to a large extent, looking back on history, Arthur Burns was a very bad Fed chair and helped at least to allow inflation to get out of control in the 1970s. And with what we saw with inflation over the past, looking at Jerome Powell's past 8 years as a Fed chair, what he's going to be remembered as is transitory. That's the term that's going to stick. And transitory is that the thing is that when inflation started to pick up after COVID really got ensconced and supply chains were really kinked and people were, in quarantine and it was getting really out of control and it was a real thing. Inflation was definitely a thing by the end of 2021. And the Federal Reserve did not acknowledge it and did not really discuss it in what should have been a normal fashion. I'm going to switch back here, take a look at the S&Ps. We see crude oil continue to go up. And as I'm speaking, we have a rally in the SPOOs. That's trader lingo for the S&Ps, and a rally in the NASDAQ as Jerome Powell continues to speak. They didn't really acknowledge it properly, and inflation got out of control. And after they didn't acknowledge it properly, inflation numbers kept coming in, and instead of saying, "Hey, whoa, maybe we're wrong, and this inflation can get out of control. We have to do something about it ASAP," they couldn't acknowledge that they were wrong, and they had to craft this language like it's transitory and it's not going to be big of a deal. And 6 weeks went by, and another 6 weeks went by, and they had one meeting and another meeting and another meeting, and it got out of control, and then it became transitory, and they really made a mistake, and they couldn't do anything about it. And a big part of me thinks, maybe it was because Jay Powell's term was up and it was an election year. But that was in 2020, and he should have pushed to raise interest rates then. But it became really apparent later in 2021 and 2022. So that idea may not be correct, probably isn't correct. So he should have been much more aggressive in raising rates. Even if he didn't raise rates in 2020, he should have been acknowledge that inflation was getting out of control and be more aggressive to raise rates in early to mid 2021. So I have to go back in time and see exactly when he started raising rates, but I think it was in late 2022 or early 2023, if memory serves me right, but I don't know for sure. But it definitely wasn't in early 2022 or late 2021. I'm gonna actually ask Grok when did, I'm gonna ask Grok and see what he has to say. Or when did the Federal Reserve first raise interest rates after COVID began? Let me see what it has to say. And it says that the first basis point was only 25 basis points. It was March of 2020 in response to the pandemic. Okay, but when was the second rate hike? I think that was a lot later. It was much later in time. 2022. There you go. So the next hike began in May 2022. Okay, so they, only raising by 25 basis points, with the pandemic, that's not that big of a deal. And then waiting till May of 2022 to raise rates, that's too long, and that's not good. And by that time, inflation was entrenched into the system. Interesting. And I think going back in time, if they wanted to raise rates, but there was some, it felt, so they raised rates by 25 basis points in March of 2020. And the reasoning for that was, it was only down 25 basis points, but the reasoning for that was, okay, we have a pandemic, inflation can get out of control, we got to be careful here. Because you had the pandemic, but you also had inflation risk from the pandemic, and that was proper reasoning, And it's hard to remember exactly what was going on at the time, but I think March, April, May of 2020. If you go back in your time machine and think about what was happening at the time, what was on the news and so forth, that was an election year, okay? And Trump was president at the time. And Jerome Powell was up for re-election. And the idea of raising rates too aggressively in that environment did not seem politically correct at the time. So, and then they introduced the transitory terminology, and that went through into 2021 once Biden was president, as COVID continued to drag on. So, however you slice it, I think he was a poor Fed chair and he made a lot of mistakes. a lot of mistakes. And I'm excited that ultimately Jerome Powell is transitory. And I'm excited to see what Kevin Warsh can do as a Fed chair. I like that he has private sector experience, that he worked at Morgan Stanley, that he's been at the Fed before. He was a student of Milton Friedman, which I love. And this idea that he's always going to be dovish is not true. He can be hawkish. He can be dovish. He can go any way. And we will see how this plays out. I wish him the best. I pray for that he does a good job, and I pray that he can have an influence on monetary policy that helps fix the gap between people that are the haves and the have-nots, and people that have assets and are able to prosper from asset inflation, from the stock market going up, from real estate prices going up, that are able to amass wealth, and other people that are not as easily exposed to assets and stocks and bonds and real estate. And because I think that is at its core the reason why we have the populism that we have, is that people are angry, not because they're poor and the other people are rich. It's that they're not able to have upward mobility and climb up the ladder. And I hope that Kevin Warsh's Fed can help even out the path for people to have upward mobility. I think a lot of rules that are being passed and laws that are being passed can help people. I think that this pattern day trader rule that is being that was passed recently and still has to go into effect, is going to have a huge impact on individuals. I think that technology like AI and other stuff like what Robinhood has done for individuals is helping people gain access to make money easier. I think that these Trump accounts are going to help people tremendously, have a big difference, a big impact on people. But at the end of the day, at this point, there's still a long ways to go. And I think that this K-shaped economy and how some people have the access to have upward mobility while other people don't is the underlying angst and anger and jealousy that creates the populism that we have today. And I'm not like other people that are doom and gloom. I think that this is part of a cyclical process, and I think that we are due for something to happen to make things better in the world. I'm an optimist at heart. Now, all that being said, we have about a half hour going in until the half hour left until the closing bell, and we have a lot of earnings today. So we've had a couple earnings in a few stocks, and the one stock I wanted to talk about that had earnings yesterday that is having a huge up day is Bloom Energy. Okay, and the reason why I wanted to talk about Bloom Energy is a stock that I have been following for quite some time, and it is a stock that I am very bullish on, that I own shares of, and I think that even though it's had a big up move over the past year, it's had a big up move in the past day following its earnings announcement, I also think that this stock can go much, much higher. And I wanted to talk about Bloom Energy also because it is a good lesson in being able to make money in the stock market. Okay. Because Bloom Energy, in my opinion, has a couple lessons, but the first one is Bloom Energy is a stock that I think is misunderstood by many of the professionals on Wall Street. Okay. And because it's misunderstood, I think that helps us as retail investors be able to make more money in an underlying stock. If you can find a stock that has an underlying thesis that is so unique that the average Wall Street analyst and money manager doesn't quite understand the business thesis for whatever reason, because they're too busy with their clients, because they're too busy schmoozing and boozing their clients and customers. They're too busy, doing all the other stuff that they have to do as Wall Street professionals. If they don't quite understand that thesis, and it's very difficult to understand if they fully understand it or not, that means that the stock usually has more upside to go, because all these professionals, both analysts and money managers, have to come around to the idea that this stock can go higher. And I think that some analysts, some managers understand Bloom Energy, but I think there's a cohort of many Wall Street analysts and fund managers that don't quite understand what Bloom Energy is all about because of the level of complexity or uniqueness in the thesis. That being said, I also want to talk about how a thesis, an underlying thesis, can propel a stock higher. So let's take a look at a longer term chart for Bloom Energy. And as we can see here, this stock has had just such a huge move. The stock was trading at just $16 a share. $16 a share in May of 2025. So a little less than a year ago. I think. Yeah. Let me just double check. Wow. Yeah. So this is 2025 here. We go back to May 2025. This stock is trading for $17 a share. And now it's at $283. And when you look at the fundamentals of Bloom Energy, we're going to pull up the Bloom Energy fundamentals right here. Hold on one sec, everyone. Let me pull up the Bloom Energy fundamentals here. I had it up and I have to do it again. Sorry. Let's pull up FinViz here to pull this up. Okay. I apologize. Okay, so we pull up Bloom Energy fundamentals here. We see the chart here on FinViz. We go back to July here. We see on the chart July of 2025. This is the start of 2026 here. It was at 90-ish a share. Go back to July, it was at 22. We go back to before that, say June, it was at 21. And on the thicker swim chart, we could see that we look at the thicker swim chart and we see that go back to May, it was trading right around $16 or $17 a share. So, huge move. Okay. And we look at the fundamentals. Okay, we look at the chart, we see the chart here, and we look at the fundamentals, and we see that the fundamentals are pretty dang good. We take a look at the sales over the past couple years, huge growth. We take a look at the EPS, it's negative, but the company is, the negative earnings are getting less and less and less, which is very positive. We take a look at the earnings growth for this year, 163%, that's fantastic. For next year, estimated at 105% growth. Next 5 years, 112%. EPS over the past 3 and 5 years, 39%, 20%. So it's very, very solid numbers across the board. And the sales year over year, 56%. It's, you know, take a look at the quarterly numbers. We see how the quarterly numbers are rising, and you see how you get some positive earnings growth, and now we're going into the positive finally on earnings growth on a quarterly basis here, 0.00. So we're finally, the company's finally making money. That's all great signs. You have a PEG ratio of 0.61. You go out and look out 1 year, 5 years, you have just over 100% growth, and you have a forward multiple of 69. So all that's very, very positive, very bullish. And you have, as we said, very strong chart higher. And Wall Street loves that. They love, I think a lot of growth managers love those numbers on Bloom Energy, and they were very bullish on the stock, and they bought that stock. One negative about the stock is you see shares are increasing. That's not good. You want to see shares decreasing over time. But that is one negative. However, so I one time asked my dad, and my dad is a experienced investor, trader, got me interested into the market. So someday I'll tell my story about my dad, and you know, how he taught me and mentored me, and how he is a self-made multi-millionaire retail investor just by picking stocks. And, so he was my original mentor, and he got me interested into the market, and here I am today, trading and investing. I did some research, and I did a lot more research than he ever did, because when he was learning about the market, you know, all they had was Barron's and Wall Street Journal, you know. And I like to dig in and read books and stuff and do studies and stuff. And I was like, Dad, I read this book and I did all these studies and stuff. And, you know, one of the main characteristics for top big winning stocks is they have super high earnings growth and super high sales growth. But they also have accelerating earnings growth and accelerating sales growth. And that's like the magic sauce. And this guy that I studied and read his book, he said that's the magic sauce. And he goes, yeah. But if you don't have a thesis, then you're not going to have any sales or earnings growth. If you don't have a reason to buy the product, you don't have a thesis, then that's not going to propel the earnings and the sales growth. And that shut me up. Because sure, the guy that did all that research and people have done multiple studies on this, and that is the case. You have of course, you have big earnings growth and big sales growth, but you have to have, when they have accelerating earnings growth, accelerating sales growth, both quarterly and annually, that is the secret sauce that comes before a big move in the underlying stock. That's all true, but you have to have an underlying thesis, something that is the gas behind the accelerating earnings and sales growth. If the earnings and the sales growth are the twin engines in a stock, the gas is the thesis. And that thesis is, what kind of Peter Lynch always talked about. You have to be able to explain why the company is a investable company to a 10-year-old, a fifth grader. And sometimes it's difficult for a professional like that's on Wall Street to understand that thesis because it's just so simple or unique, and they get they get bogged down in all the numbers and how everything has to be by the book and live up to the model and so forth. And Bloom Energy is one of those things because it is an energy stock just like many other energy stocks. However, it's a unique energy stock because it solves a problem in it solves a problem that is being created by all these data centers being built, that has created a huge demand imbalance, and there aren't many solutions to this problem, and Bloom Energy is a solution. It's not completely easily understood to understand this dynamic. That yes, we have energy demands as we build out data centers, but we also don't have enough copper, and we don't have enough transistors to build out the energy grid in the normal way that we would like. And Bloom Energy provides fuel cells through natural gas that can be hooked up in less than 90 days. And they talk about this on their conference call. And they talk about this on podcast that you have to dig for. Or you have to listen to the earnings call, which I don't think a lot of people do, to understand this dynamic that they solve the problem that is existing. And because they solve this problem, the stock should go higher. And that's what my thesis was, that the stock needs to go higher because these hyperscalers and other companies that are building out data centers are going to have to come to the conclusion that they need the Bloom Energy technology, and they're going to have to sign contracts to buy the Bloom Energy technology, these fuel cells, and that is not yet being priced into the stock. And I still don't think it is yet. And as the demand keeps going up exponentially, I still don't think that Wall Street has fully understood that the more and more companies are going to come to Bloom Energy needing their technology. That dynamic of having an underlying thesis that propels the business of the stock, in addition to having a complexity or uniqueness that Wall Street analysts can't quite understand is gold. And it causes a stock to go up a lot. And Bloom Energy is a perfect example, because if we scroll down here, we took a look at the fundamentals, we took a look at the chart, we scroll down here and we take a look at all these analysts. Yes, there are analysts that have buy ratings on Bloom. HSBC, Jefferies. Look at the price target, 187, 150. TD Cowen's at hold, and their price target's 235. I mean, look at all these downgrades. HSBC in October. Mizuho, downgrade to $79 a share. Jefferies, downgrade, $31 price target. There's still a lot. Look at all these hold, neutral, equal weight, low price targets. They don't quite understand. They may be moderately bullish or slightly bullish on the stock, or outright bearish on the stock. Regardless, they don't quite understand that Bloom Energy is a company that has the solution to fill the demand in this AI build out without much competition, and that is not yet priced into the stock. Even today, I still don't think it is. And the reason why I still don't think that, even though the stock has had a huge move, we have two gap ups recently. Looking at the analyst ratings and price targets, I still don't think that they understand Bloom Energy. And because they don't understand it, I think that is very bullish for the stock. So when you have a super bullish thesis and you have the professionals that don't quite understand a stock, that only means that eventually they're going to have to come to the realization that they need to raise the price target on the stock, raise the rating on the stock, and that pushes up the stock, because then the money managers that are associated with the analysts have to buy the stock. So it's kind of that trickle up effect that pushes the stock higher. And until the bullishness on Wall Street has been priced into the stock, I still have to be super bullish on Bloom Energy. And if we take a look at here, you have the moderate price target still at 235. The price is at 282. This needs to come to this. Get it? Looking at these ratings and these price targets, this needs to come to this. And this 2.3 needs to go below 2 and closer to 1. And until that happens, I think you still have to be bullish on Bloom Energy. And I think it's only a matter of time. This is on a bigger arching. That's looking at the analyst and how Wall Street has priced in a stock like Bloom Energy. But then looking back at the overarching thesis that is the fuel behind the earnings, there's still a lot of hyperscalers that haven't come to the conclusion that they need to use Bloom Energy. And that's my overarching thesis, is that eventually they will do what hyperscalers like Oracle have done, and then sign contracts with Bloom Energy. Whether or not that happens, we'll see. Other investors like Chris Camillo agree with me, and I think he's spot on. And we don't know when that's going to happen, but that's the bullish thesis. And at a certain point in history, when everybody has Bloom Energy as a buy, and every single hyperscaler is using Bloom Energy, the upside potential is going to be gone. So that will happen sometime in the future. That's my bet. So that's what I wanted to talk about today with Bloom Energy. The next thing I wanted to talk about as we head into the closing bell, we have a couple earnings. We have some earnings uh, that are coming with some Mag 7 hyperscaler companies that are coming out after the bell today, and also some companies that are coming out with earnings later this week. So today after the bell, we have go through these companies one by one, and I'll show you guys the expected move, so you'll have a better idea of how much the stocks can move after they have earnings. You can always have a good estimate of what a stock can move with earnings, up or down. You don't know which way they're going to go, but very often you'll have a stock that will move a certain amount. You're like, oh my god, on CNBC or whatever, like, oh my gosh, I can't believe a stock moved 20 handles, on earnings. And I'm like, the expected move was 20 points. It was expected to move about 20 points. Because those people don't understand options or volatility and so forth. So the market does, it's not perfect, but it does a very good job. About 68% of the time, it predicts the movement up or down in an underlying stock. And so looking at that expected move is a very good way of having a very rough guide of how an underlying is going to move with earnings. So let's take a look at the three big hyperscalers that have earnings tonight, and that is Microsoft, Google, and Amazon. Take a look at Microsoft here, and we look at the options that expire in 2 days, and we take a look at the market maker move, and the market maker move is just a volatility Black-Scholes type of calculation that is a little different than the calculation that we have here on Thinkorswim. These options expire this Friday, and I think what happens is they kind of time weight that number to get another number with the market maker move, so it gives you a good idea of what the expected move is. And it is $28 here in Microsoft. $28 up or down. The market maker move is $27. So that's about $28 for Microsoft as we go into the closing bell. So take a look at the chart here in Microsoft. $28 in Microsoft, and it's at 423. So that's 423. It's 28. It's 450. So look for a move up to 450 to the upside, and down to about a little under 400. So about 395 to the downside. So that's where we're looking for a move in Microsoft. Let's take a look at 5 minutes left until the closing bell. 5 minutes left until the closing bell. Let's take a look at Google. And Google's a little tricky because there's Google and there's Google L. So take a look at Google L, and we have a $19 expected move, and the market maker move is $18. So $18 to $19 to the upside or downside. So that's about 330 to the downside, 327.50, somewhere around there. About 328, $329 a share, somewhere right around there. Looking for a move to the downside, and then we look at. Sorry, that's 2 sigmas. My bad. 350. So $19. Sorry. So that's about 3. What am I thinking? A big mistake on my part. my bad. Yeah, my bad. I'm sorry. So we're looking. Yeah, so that's about 331. Yeah, so about 330, 331 to the downside. And we're looking at about, yeah, about 370 to 372 the upside. So somewhere right around there, 370 to 372 the upside in Google. So that is the expected move in Google. And so we have 3 minutes left into the closing bell. Take a look at Amazon, the expected move in Amazon. And market maker move is $8. Sorry. So we're looking at not that big of a move in Amazon, $8. I would have expected it to be more, but $8. And so we're at 262, so 270 to the upside and about 255 to the downside, give or take, in Amazon. Those are the expected moves in those stocks. Now tomorrow we have Apple, I think. Yeah, tomorrow we have Apple. So let's take a look at Apple and see what the expected move in Apple is. And I think that I also want to look at the expected move in NVIDIA, because I think that the earnings in these hyperscalers are going to have a big impact on what NVIDIA does. Because if you have any change in CapEx, in capital expenditures in these hyperscalers, whether companies say they're going to raise CapEx or, oh my God, cut CapEx, that is going to have the most impact on NVIDIA. And so as we take a look at Apple for tomorrow, it has $11 expected move as we head into the earnings. And I think the market maker move is messed up. So yeah, as we go into earnings, up or down about $11. So for Apple. And let's take a look at NVIDIA, because I do think that these earnings and these hyperscalers are going to have a big impact on what NVIDIA does, because those are NVIDIA's customers. It's these hyperscalers. And as you see, NVIDIA doesn't have earnings this week; they report last. But I do think that it'll have an effect on NVIDIA's earnings. And for the week, we have a $7 expected move up or down. And I think that right now, if we look at the chart on NVIDIA, that 212 level is key, in my opinion. We got to get back above the 212 level, and we're just slightly below it today. We're just hugging that 212 level as we go into the earnings for these hyperscalers, and I think we need to get back above that 212 level, and actually now we need to retest the new high of about 200 and, let's see here, that is 216, close to $217 a share, as we have 13 seconds until the closing bell. And we will see how earnings play out. And see what happens. So I think it's important that NVIDIA gets back above 212, that key level, which is the previous high. And good earnings from hyperscalers will do that. And if we look at the extended hours, take a look at NASDAQ. It is popping. Take a look at another screen. I'm taking a look at NVIDIA. It is still at right around $209 a share, even though NASDAQ is popping. So I don't know if earnings are out yet or not. Anyways, that is it for today, everyone. I will talk to you guys all later. I hope that Bloom Energy is a good lesson, that you have to have a thesis. That is the fuel that propels the high earnings, the high sales and the acceleration of that earnings and sales. So my dad has good wisdom there. It's like, that's good, accelerating. But what's the thesis? If there's no thesis, then you're not going to have good earnings or sales. And now, as I'm speaking, Nasdaq is now moving down. So we'll see what happens. Maybe that was just a reaction. We got a lot of earnings coming out today, and there's other stocks that aren't as big, that aren't the big Mag 7, but are big technology stocks like Qualcomm's coming out with earnings and stuff. Many other companies. This is the peak earnings season right now. So let's see here. I don't know if any big companies have come out with earnings, but we've seen lots of reaction, lots of moves as we're waiting for earnings to come out. So with that, like I said, Nvidia is right at like 209. It hasn't really moved since where it closed. So I think that's going to be the most impacted stock. These hyperscalers come out and say they're spending more and more capex, and I think that they will, because they're at an they have the thesis behind that is there's an existential threat. They have to spend, not just to beat out other companies, but to beat out China. It's like a Cold War space race type of thing. With all that said, and the NASDAQ popping like the way it is, I'm going to sign off, and I will talk to you guys all later. Take care. Good trading. Bye-bye.